All right, traders, welcome to the end of the week and today's recap. This is Christian Fromhertz, Tribeca Trade Group, and it is Friday, August 19th. So to conclude the week, we will certainly go over all the performance data for the week, give you a week summary. I like to start with these Friday videos with just going over what the themes of the day were, what some of the outperformers were, underperformers were. But I think there's some takeaways, I think, to that we can come away from now that the week is complete, and also kind of talk a little bit about a plan for, what the technicals are telling us at this point. This was something that we went over in detail. We had a midday video with members today. I think the midday video was long. Normally we do like 20 minutes. But today I did about an hour just to kind of, go through and kind of debate some of the things that we're seeing in the marketplace and kind of go from there. So yeah, our format, what we do, and I think I actually have to change this on the right side of your screen, but I provide commentary. We do pre-market commentary at Tribeca Trade Group every day of the week. We usually start like right around like 9-10 in the morning, and we go over all the macro moves and some of the more interesting things that are going on pre-market, as well as we go over chart setups. And then midday, we kind of I changed the format a little bit so that now I'm sending out a note, basically, for those that can't be in front of the screens all day long. This way they can get a quick summary of what the main market observations are, and then charts that I'm watching, what sectors are moving and where there's relative strength, where there's some really interesting things going on. So we do that Monday, Wednesday, Thursday, and then Tuesday we do a midday, we do midday commentary, and then Friday, like today, we do kind of summarizing the whole week and thoughts ahead, and plus Q&A. So it's a little bit about what we do. We do a lot of things at Tribeca Trade Group, so that's part of it. And yeah, so let's get into some of the analysis for today. So very like this was an easy one to figure out, not so good for the markets, but just basically everything today indicated risk off. So of course, one day is not a trend, and we're going to go over the whole week. But when you look at, and we'll start with the US dollar, I think is probably the best thing to do. And then we'll talk about the indices. But, pretty big move in the US dollar this week. Where is my sheet for the week? US dollar was up 2.4%. And, the thing that kind of strikes me that stands out here is that, and I did go over this in yesterday's video too, because it's been strength basically all week, right? We started to see this kind of move back up, but what strikes me here is everybody got excited about the break of the 50-day moving average, and hey, maybe that's it for the dollar strength. Nope, this kind of seems to be a false breakdown, and I think you can kind of conclude that at this point, because this was the first time the US dollar got below the 50-day moving average since all the way back in here, right, which was February. So it was pretty significant to me. But however, sometimes we see this, sometimes we see false moves, right? So we're getting very close to those previous highs. So what does that indicate, right? If you're not familiar with, looking at the US dollar and what it signals, but it signals risk off, right? When the dollar is really strong like that, it's a little bit of a flight to safety. And the reason why it's just not so good is because a stronger dollar, just, for anybody who's got international operations, they're going to pay, to bring things back, for the currency translation. So it makes businesses who have, international operations just more expensive. It's more of bottom line, it's more of a headwind. Now, a couple of things in the technicals, and I'll do this in the euro too, but there was a virgin point of control that was taken out to the upside. So now the question remains, are we going to see a new breakout here in what we in the US dollar, like, further than what we saw back in July, right? Or are we going to kind of stall here and make a lower high? So that's to be continued, and I think you're going to hear me probably say, to be determined, or to be continued in a lot of these things, because once we start moving in one direction, we need a little bit more evidence, right? So the euro is a big thing, right? This had a very weak bounce, out of all the currencies, this one was very weak in terms of bounces, and it's heading back down. So same thing here, except to the downside, is this going to make new lows, right? Or was this version point of control takeout from back in here, maybe signaling that we might get a bounce back in that direction. So again, remains to be seen, to be determined. But for now, we know that the overall level is not so great, right? And then another thing too, which is important, is what is going on with bonds. Also notice another version point of control taken out. So again, these are, I know that if you're watching this video and you're not a member of Tribeca Trade Group, you probably don't have the full understanding of what I'm talking about with these, but a lot of times you could see reversals off of version point of controls. You could see one right in front of you too. This was as high as we went when bonds were going up and yields were going down. Remember, with bonds, it's an inverse relationship. As bonds go up, that means yields are going down. So notice this one was taken out, right? This was back in the beginning of August, and that's as high as bonds went, or that's as low as yields went. So you got version point of control to version point of control. So the question will be here too, is are we going to now see a bounce now that this has been taken out? All right. Again, we're going to need more information, because just like with the US dollar analysis, those were just taken out. So we need more information. If we look at the daily chart here, right, notice that there's more support ahead, but we've broken the first support level, and that's basically the 50-day moving average. All right. So again, I've said it now for weeks. I said one thing that we don't want to see is yields going higher, right? That's not going to be good, especially for the growth areas of the market, right? And if you want to look at yields, because again, I talk about bond prices and I use it in that perspective. Some people like to chart TNX or the 10-year yields. You could do it that way too if you just want to see the yield. But here's what the US is right now. We've got the 30-year at 3.2, we've got the 10-year at 2.9, and then you've got some of that inversion where the 2-year is actually higher right now than the 10-year yield. So that's yield curve inversion, right? And then of course, we're talking about 2, 5, 7, longer maturities, right? And then of course we have this going on, which is what the Fed controls, is the short end of the curve, right? And we know that this kind of went back and forth between 60 basis points to 68 basis points this week, right? We're at 63 for this September meeting. We might get more of a picture with that with Jackson Hole's speech next week for Powell, but I don't think it's really going to change that much. I think if he does something different, it's going to be a big surprise, because we've only had 1 month of inflation data that has indicated that it didn't go up further from the previous month, but it's only one data point. So very logically, what every Fed speaker has been telling us is that we need to see more confirmation that inflation is going down further. So we're, in my opinion, we're not going to see much, but you can start to look ahead, right? We're halfway through August. We're going to have this towards the end of November. Sorry, this towards the end of September, right? And then so even if it's 75 basis points, right? Then if you look for the next month, it's probably going to be 25 basis points. So we're kind of talking about, a percent to maybe 1.2% from here. But then that's it for hikes as far as what the curve is currently pricing in. Then we start to kind of go the other way in terms of what the Fed fund futures are pricing. I'm not here to debate whether or not, and it's funny, I see all these every once in a while. I open up Twitter and I hear people debating about what they think is going to happen for the next month. All you have to do is look at Fed fund futures. That's what the market is telling you, right? So you don't have to speculate about whether this is going to happen or that's going to happen. It would rather be, this is what it is telling you currently. Now, this of course can shift. If we get new information, some type of new information, the market's going to change. But right now, this is what the market is telling you. So again, I find it funny that people debate this stuff, right? You have the information, right? Whether you choose to look at it is something different. And I get it. A lot of traders on Twitter are just not informed. They may not know that what Fed fund futures are and know that the market is pricing in exactly what they need to know, right? But so that gives us a view. All right. So I mentioned two things that were risk off for the day. I'll keep going here. I'll speed up a little bit here. But Bitcoin kind of broke down a little bit, down 9%. You may ask yourself, right, why are these moves so big to the downside with Bitcoin and other cryptos? Well, because it's the mechanism of what happens when people are on margin. It is much, most people are familiar with margin calls, or understanding what a margin call is in the equity world. There are no margin. There really aren't margin calls in the crypto space. What happens is if you're on margin, right, and the level goes below what kind of whatever margin you have posted, they don't call you and say, hey, can you bring in more securities or bring in more money to satisfy the margin call. Your position gets liquidated, right? That's how for whatever reason, I don't know why, but that's how the crypto world works. So if you're on margin, you just get blown out. So when you think about, so it really becomes, how large is the margin right now? How many people are on speculating with margin on cryptos? The more people are, the more that once cryptos start going down, the more violent the move is, because all of these funds are just being sold because they don't have the option to satisfy the margin call. It's just liquidated. All right. So we see this time and time again in the cryptos. But bottom line here, Ethereum down 10%. That's been a pretty good risk off indicator so far for what we've seen, especially this year. The VIX was up a little bit, so you would think on a day like this, where all those things that I just went over, you would think pretty bad, right? I mean, not that big of a move for the VIX, right? And if you go back to what we experienced in other places, this year, back in the beginning of June, the VIX was 24 and shot up to 33. Could we go back to 23, 24? Of course, because it's really not that big of a move, but it's just kind of surprising, right? Now, again, the role here is not to speculate and argue with it. Oh, it's definitely going higher, whatever. This is just telling you what short-term S&P options are currently pricing out in terms of implied volatility, right? There's no, saying, oh, well, it's mispriced or it's not. It is what it is. Just like we look at Fed fund futures, the market's just not pricing in as much volatility as other times that we've had, some of these down moves. So the kind of leaves us to, let's talk a little bit about, equities and what transpired this week. So a couple of observations here, and let's start with the for whatever reason, I'm going to start with the short-term chart for a minute. We did break into value. We were kind of holding this in the beginning of the day, but it wasn't like a major breakdown today. In fact, we actually took out the lows around 3 o'clock today, but it wasn't like a major plunge to the downside. So it still feels a little bit different in terms of volatility. A couple months ago, we were seeing that once the lows were taken out, we would just keep going lower. So to me, right now, and it's just what I'm feeling, but I'm using the chart for that too. But, okay, so down 1.3%, that's not a great day. And the breadth was bad again today. That's almost every day this week. Yesterday it was slightly positive, but that's another big breadth day. So that is similar to what we've seen, where breadth is pretty nasty, right? Here was a virgin point of control that was taken out. We basically closed right at it. The 5-minute virgin point of controls are not that significant, not as significant as a daily one, but here we are. And yes, we did get rejected right at that 200-day moving average. So again, that's why I have it on my chart. A lot of people, a lot of traders look at this. So what's the difference of what we, one difference from this whole large swing up that we've seen, right? This is really the first time that the price has gone below the 5-period moving average, right? Since, it kind of tested here. It tested a little bit here, but basically for a month, we've had this swing above, and we're now below the 5-period moving average, and that's starting to slope down as well. So what do you do at this point, right? And what's the next thing down where we could get to now that this now that we're sliding below the 5-period exponential moving average. Next thing I have is the 20-day moving average, and that lines up with this extension from the August value area. So the moving average has really kind of helped me a little bit when we're this far above the value area for the period, right? Because the support down here is not really going to help you too much because we're just too far from that. The extension away from the value area may help, and the 20-day moving average would be a logical place for us to come down and visit. And what do you think would happen if that happens, right? If we come down to the 20-day moving average, right, we know that what has changed over the last couple weeks is the sentiment has changed, right? People have gotten a lot more bullish, right, than they have, from the lows. So if we come down here, we'll probably wash out a decent amount of the sentiment, considering when you look at what value versus growth is doing right now, right? Value in some of the defensive areas are really outperforming, and the growth areas of the market are really getting hit pretty hard. So you get another day or two of this where it's pretty bad breath, you're going to have the sentiment pretty washed out. So that's kind of the good point. But we don't really know until we get there, right? So it's logical that we do see some type of, pullback and into the 20-day moving average, but we just don't know until if we get there and, if that's going to hold. So what do you do until then? Well, you have to practice risk management. We had a webinar a couple of weeks ago specifically talking about managing risk, right? And being, being a risk manager, which is half of what this trading is all about, right? Some of, part of it is, okay, identifying relative strength, finding good setups, but the other half is how you're trading and how you're managing your position. So, what did I do today? Well, I put on my first hedge, like overnight hedge. I've been hedging some things kind of intraday, but I put on my first hedge today. Why? Because something has changed in the market, right? And I'll take that hedge off if the price gets back above the five-period moving average, right? 5-day moving average. So that's what you have to do as a risk manager. You recognize when you have good opportunities, and you recognize when the market is changing, right? You don't want to sit and bite your nails. You want to have a plan, right? And that's what we do, right, at Tribeca Trade Group is to think about things rationally, think about things objectively, right, and adjust to what the market is giving us versus what we want it to be, right? It's all about making adjustments, and I think you're probably no stranger to that. With what we've experienced this year, if you've been adjusting to this market as we've gone along here in 2022, then you've fared a little bit better. If you've been stubborn and said, I'm not doing this, or I'm going to do what I want to do, and I'm going to diamond hands hold things, then your performance probably speaks for that, right? So I talk about this all the time, but this year has been a great education for traders, provided that they're taking steps, and learning along the way. If you have that mentality of diamond hands and I'm going to be stubborn, then maybe this year you didn't learn much, and that's a whole nother story. But for most traders, I think this has been a very good learning. This year has been a very good learning experience, and so that's the rule. That's what I did today. Also making some adjustments, because if you look at the performance, and I'll bring up, this is the performance for the day, but if you look, there wasn't very much in the green, but what was in the green is just your more defensive areas of the market, right? Things that really got hit. And it's pretty amazing to see this PBW, which was down 5.6%. Remember, the clean energy stocks had a huge week last week, up 10% last week, but believe it or not, they gave back all the gains. So really kind of concerning there to see the clean energy move, right? And I'll bring up PBW here. Right, but they gave back the whole move from the previous week. So that's not what you want to see, and that is starting to look something similar to that. So again, you might see some things. One of the things that we talked about yesterday is what, for a couple of weeks, I guess a couple of weeks, there was a lot of things that were rallying together, right? And when that happens, when everything is kind of correlated like that, and there's a lot of short squeezes, a lot of different groups are moving together, eventually those are going to separate, right? And you're going to learn what were the real moves, where's the quality in the market, where's the relative strength, versus some things that were kind of kind of fake moves. They were moving on momentum. They were moving on some short squeezes. And I think those are really going to start to reveal themselves a little bit as they did this week. But that's something that we're also going to see, I think, for the rest of the year. So when you look at the performance for the week, so this is kind of interesting for a couple different reasons. So first of all, when you look at like the big, one of the biggest movers this week, IWM, right? Remember what it did the previous week. So IWM was down 2.9% for the week. The previous week, it was up 5%. So, okay, that's not that bad because net, that's still a gain. And by the way, the market broke this streak. The market, the S&P was up 4 weeks in a row. So this does break that streak of up weeks. So again, like, that was inevitable, right? That, whether it's this week or next week, whatever, the market's just not going to go up every single week, right? But S&P was just down 1.2%. The diamonds outperformed. Qs were down 2.3. They were up 2.7% the previous week. The international areas continued down. We already talked about bonds and the dollar, but those are standouts. And then gold just continues to, gold, what do they call them? Gold bugs. Gold bugs, is that what they call them? People who love gold no matter what. Sorry, but I just can't make heads or tail of what gold is doing. It doesn't seem to be doing anything but really going sideways, and we'll look for a further trend once it appears. But for now, very, very sideways, and sideways to down, right? And then, of course, one of the things that I think that was kind of overlooked or got overlooked last week was value versus growth last week, in the big rally that we had where the S&P was up 3.3%. Last week, value was up, when you look at VTV, which is what I have here. Again, this is not last week, but the week prior. Value was up 3.7% and growth was up 3.0. This week, even more outperformance by value. Now, value still finished down for the week, but only down 0.3%. Right, and growth finished down 2.3. So I talked about how you've got those headwinds with bonds, right? The further those yields go higher, the more that this is going to hurt this guy, right? So we'll have to see if that continues. And if you look at the performance for the week, you've got things like consumer staples, a lot of value areas. What didn't participate, which participated a little bit more. Didn't participate yesterday, but had some outperformance today, but still finished down for the week, was healthcare, down 0.5%. Energy was the outperformer, right, along with the staples. So, and the utilities were up 1.3. So altogether, pretty risk-off stuff, right? Blockchain stocks really got hit, down 11% this week. Gold miners were down 7%. Pot stocks, solar, Chinese internets. FANG stocks were down. The internet ETF was down 4.5%. The builders were down. The semis were down 4% last week. What were the semis? The semis the previous week, where do I have them? Yeah, that's pretty bad performance, because I think they were only up about 1% the previous week. All right, so there's your performance. Definitely a risk-off week, right? And I think if you look at some of the things left to right that outperformed versus underperformed, some things really got hit pretty hard. So, bottom line is, we kind of outlined a couple scenarios that could happen. One of which is we could fall down to the 20-day moving average. And then we kind of have to see what happens there, right? And it's going to be an exercise in risk management, right? If we get down there and we break, right, then we don't really have much support until the 50. So you have to think about what you're going to do. For me, I will be mostly in cash at that point, right? That's my, once we break that 20-day moving average, then we've got a much bigger move to the downside. All right, so we'll kind of see what transpires here. Again, option expiration today, so that kind of really moves things around a bit. I think next week is going to be a very interesting week. And what did I want to go to next? One other thing so of course, price and trend are number one for me, right? They tell the story. I think price has the majority of the information that you need in it. But I also like to look at some indicators and positioning. What I find also pretty interesting, and why, so I'll give you what I think, right, in regards to the rest of the year. I don't think that we go back to new highs. I think it's possible that we could go up and take out this version point of control, but I don't think we go back to, I don't think that we take out the lows here either. I just think that the positioning has changed quite a bit, right? There was quite a bit of unwinding, right? There was some big growth funds that unwound a lot of their positions, right? Liquidated their positions, right? So I don't think that you're going to have that same type of liquidation, even if we start to move to the downside. Just like I was talking about today, today wasn't as vicious as some of these other days that we've seen. Now, if you look at the positioning that's happening, now again, this is just index. So please don't come at me with an angry tweet saying, hey, I've seen short interest reports and it's indicating that there's been a lot of short covering. That's for single stocks. Okay. That's different than there's just different things that go on in the market, right? Some people love to analyze, what the option positioning is. Okay, that's fine, but that's not the whole market, right? So single stocks, if, there has been some, from what I understand, there has been some decent short covering in single stocks, but that's not the whole market either, right? There's also the futures positioning. There's also what goes on in ETFs, right? So there's a lot of different things that go on into the market, right? And trying to put, now you're never going to be able to put all the pieces of the puzzle together, but we could try to look at some pieces and say, huh, that's interesting. So this is the S&P positioning. This just came out 8/16, right? And this is the non-commercial. Non-commercial essentially means speculators, right? So what are the speculators doing right now in terms of their again, just S&P futures, not single stocks, right? But look at the positioning that you could see. So the CFTC puts this report out every week, right? They are as short as they have been in 2020. Right. So do you see how the positioning has changed? This is not where it was back in, let's say, March, April, May. This is where the positioning was. These guys are already super short, super short, right? And that's the biggest short level since 2020. Now, I'm not saying that this happens the same way, but what happened in June 2020, right? The market rebounded pretty decently. Okay, so again, I'm not one of these people who overlay a chart with another chart and say, right now, for instance, you see a lot of people doing this, and by the way, this like really cheap, cheesy analysis is done every single year, overlaying where the current market is with some other period. What the flavor is right now is overlaying a chart now, an S&P chart with 2008. This is garbage, right? That's really, again, I've used a couple different adjectives, but I think you get my point. That's not very good analysis. You have to look at some other things, right? Rather than just the S&P, what was happening then versus what is happening now, right? So anyway, I'm not going to go off tangent, but it's just, in my opinion, it's not very good analysis, right? So also looking, like, if you want to look even further than that to see at other times where the speculators have been really net short. Again, the speculators are very interesting to me because the speculators are wrong. So, if you go back and for some reason this looks a little bit different, but it's at a very low level. Okay, so we're back to basically these 2000 levels in terms of their short position, and you could look to see what the institutions are doing too, right? This is the asset managers. They have actually been buying back. Not buying back, but because they're not short, but they also have a very low positioning. So again, this kind of goes back to what I was saying about some funds and their single stock positions, having to unwind their positions. Notice that they have one of the lowest positions. This is the 5-year, but we could go back and we could look further, right? This is a very low level of exposure, right? That is going on within for the institutions. Okay, much lower level than some years past. So again, the position, when you look at to see like who's long, who's short, and so forth, it could help you kind of understand where this market might be headed towards. By the way, and look at 2007, 2008, right? The asset managers are they've got a much smaller position than they did back then. Okay, so again, you can't just look at one chart and overlay it with another period and then make a conclusion based on what happened at that time. It's a different time. Again, I traded through 2008 to that 2009. I traded institutionally. This is not that time. There are multiple reasons that this is different than that. Okay, so I know people have it on the back of their mind how bad things got. And anyway, so again, I'll move on here. But I thought that was interesting. And then another point that I've been making too is like what's been going on in this fund, this SQQQ. Right, they are still have a huge short position, right, in this triple levered short. And who uses triple levered short ETFs? Well, most likely speculators do, right? And again, the speculators, I don't want to say that they're always wrong, but they're wrong a lot of the time. All right, guys, so I'm going to leave it there. The main thing, the bottom line is markets are showing some things that are getting me concerned, right? That stronger dollar, the higher yields, right? That is a cause for concern, definitely. All right, and we're just going to have to kind of play very important risk manager as we go along. For instance, I put on a hedge today. More than what I usually do, which is just maybe day trading, right? And mainly what I'm looking at, I took off one position for a stop, right? More of a tech type name, right? It is what it is. That's going to happen as the market, if the market starts to fall further, that's just part of being a risk manager. But you could see, here's my trade that I have on, which is SQQQ. That's my hedge, even though it's not really the smartest thing to do to have a triple leveraged play on, but I would rather have this on than put options, which the decay is much more than that. All right, guys, that is it for, just a couple things that I thought were, again, I like to kind of give some single stock setups. I like this VRT. I like some of these healthcare names. I think this VRTX, remember, had a nice move, back checked, big move, right? And 3 little candles in here, low volume. So this is definitely a name I'm watching next week. ACHC is a name I've been kind of in and out of, right? But it's starting to kind of make its way back up. I think also the coal names, which I talked about in yesterday's video, they all look still pretty good, right? Oxy was this big move today. This was a trade idea that we had mentioned if it broke 66. My goodness, it broke 66 and moved all the way up to 71 on rumors that, or a filing that Warren Buffett did, Berkshire, that says that they may look to increase their position to 50% of the company's shares. I'll leave it there for the week, guys. Have a great weekend. See you back on Monday. By the way, oops, let me just get this over here. My final plug before the weekend. If you're not a member of Tribeca Trade Group and you like some of those things that I talked about in the beginning of the video about having a pre-market session or having somebody that sends you some trade ideas during the day and kind of tells you what's going on, gives you a sense of what the market is doing and an overall feel for things that are going on in the marketplace, sign up here, and you could go right to here to sign up. And I would say give it a try for a month. And there's no obligation past the month. You could cancel at any time, but I would love to hear your feedback. If it's something value add, let me know. And if you come in and you really hate it, we'll have a talk about it. All right. Thanks very much. Have a great weekend, and I'll see you back on Monday, guys.